Key point 1. It's never too late to master money management. Learning to manage your funds will provide you with financial stability and peace of mind. Let's look at the story of Rachel Richards, a thriving, self-made woman who owes her success to intelligent money management habits. Rachel first started learning about finances at the age of 11 by reading financial literature. She later majored in financial economics and graduated with 0 student debt. Upon graduation, Rachel pursued a career in financial advising. Now she's an avid investor, business owner, and personal finance geek who people constantly ask for personal financial advice. Financial education doesn't have to feel like a chore. It is never too late to change. Of course, if you started saving up in your 20s, you'd reap a greater allowance than starting when you're over 40. But the trick is to get started, anytime, anywhere. Nevertheless, putting a portion of your monthly salary aside is not the only or best option you can choose to accumulate wealth. The good news is you can learn financial literacy at any age. All it takes is patience and courage to change your habitual ways. In minutes, you will realize that life without debt is possible. You will learn how to calculate your net worth and golden number. Additionally, the ins and outs of trading and the best conditions for setting up a credit card will no longer be a mystery to you. Isn't it fascinating? Let's take a deep dive into this matter. Key point 2. Assess your financial situation and set a goal for the future. Start with budgeting to find your golden number. You might wonder what that means. A golden number refers to the funds you have at your disposal after your expenses are taken care of. Here is how you calculate it. Write down your monthly income minus taxes on a sheet of paper. Divide your expenses into categories and determine how much money you spend on each area of your life. Remember to include transportation costs, subscriptions, gifts, donations, and more. Write down estimates when you don't have exact numbers. It would also help to add an extra amount to cover any forgotten monthly charges. Add up your expenses and subtract this amount from your monthly income. The difference is your golden number. Why do you need this number, and what should you do now? To begin with, make sure your golden number is positive and work on making it more prominent. The more you can save, the better. You can download free budgeting worksheets from Rachel Richards' website for calculations. Then, start tracking these expenses over the next few months and try to learn more about your spending patterns. Once you start tracking your expenses divided by category, you will see the areas where you overspend. Next, make a budget goal. The key is to spend less in each area of your life, regardless of how small the sum may seem. If you struggle with overspending, try setting a cap on your expenses to avoid going overboard and stay on track with your financial goals. Be honest with yourself about your finances, and you'll build a healthy relationship with money. Did you know? According to a recent report by the Federal Reserve, 40% of Americans can't cover a $400 emergency expense. This shocking number reveals how widespread financial instability is. Fortunately, you can avoid being part of this troubling statistic. Let's uncover how to build a financial cushion and secure your future. Key point 3. Divide your savings into 4 categories. As surprising as it may sound, you have 2 financial goals. Building your assets, tangible and intangible resources with economic value, cash and cash equivalents, bonds, property, copyrights, royalties, and others. And minimizing your liabilities, what you owe other parties, loans, debts, mortgage, and the like. In short, assets increase wealth while liabilities subtract from it. Before we move on, it's essential to calculate your net worth, how much wealth you possess. Here's a formula that defines net worth. What you own, assets, minus what you owe, liabilities, equals net worth. Perform these calculations regularly to stay on top of your finances. To make your money work for you, give continuous compounding interest a go. In simple terms, you can put your funds into an account where a sum can grow over time. The next tip will be game-changing. Organize your savings by assigning them to different accounts. Sort them by market liquidity, how quickly one can turn an asset into cash. Bucket number 1, an emergency fund. Set at least $1,000 aside for an unexpected event. Keep this sum in cash or ensure you can convert the money into cash immediately if needed. Interest rates are not relevant here. Fill this bucket first. Bucket number 2, midterm savings, 1 year or less. This account will provide you with stability in case of a job loss. It's a good practice to save about 3 to 6 months' worth of your living expenses. You can also use the second bucket if you plan a large purchase. Due to a lack of liquidity, the stock market is unsuitable for midterm savings. Choose a high-yield account instead. Bucket number 3, future-oriented savings. When an account with your minimum term savings has enough funds, it's time to move on to the third bucket. You can use the money accumulated here for various purposes, for example, buying a house or saving for a grand wedding. Since you will not need these funds for years, investing them in the stock market would be best. Bucket number 4, retirement savings. To start saving, you should open an IRA, contribute to a 401k account, or use another retirement account. Since retirement savings require a much more considerable sum than other buckets, you will contribute to this for the rest of your life. Key point 4, by all means, try to stay out of debt. Debt creates unnecessary pressure and borrows from your future income. Still, there's a type of loan that very few people can avoid: the student loan. Luckily, there are ways to ease this financial burden. Pre-college. If you're one of the fortunate few doing what you love for a living, good for you. However, if you're not quite there yet, it would be best to focus on paying the bills while pursuing your passions on the side. With a solid financial footing, you can invest time and money into achieving your biggest dreams. Post-college. If you're considering consolidating your debts, choose a private consolidation type. This way, you can be eligible for a reduced interest rate. Parenthood. Regarding savings for your child's college education, consider the 5-2-9 plan. The key is to start early to give the money time to grow. Still, there is one hypothetical downside to consider. You will have to change the beneficiary should your child opt out of college. Otherwise, there will be tax consequences or penalties for withdrawing the money instead of spending it on college. You can only reduce your liabilities by getting out of debt. Do not take new loans to pay off the old ones. Another proverbial bad guy that can potentially increase your debt is a home mortgage. If getting a mortgage is your only option, it is wise to choose a short-term one. Apart from becoming debt-free earlier, you will build equity in your property faster. Before buying a house, there's a question you need to ask yourself. Do you plan on living there for at least 5 years? If so, becoming a real estate owner is a great idea. However, if staying there for that long is not an option, please reconsider your purchasing decision because you could lose money to fees and commissions if you sell your property too early. Other common types of loans are second mortgages, customer loans, commercial loans, cash advance loans, or short-term, high-interest loans that bridge the gap between paychecks. Borrowing from your life insurance policy, and borrowing from your retirement savings. Key point 5. Once you have the money in hand, please don't rush to invest it. A stock market is where people can buy and sell stocks and bonds. Stocks are units of ownership in companies. Please note that the potential returns on stocks are higher, but so is the risk involved in investing. They also offer limited potential losses while having unrestricted potential gains. Bonds are IOUs with you as the lender. They are less volatile than stocks and thus offer lower returns. Diversify your investment portfolio to lower the risks. There are 4 golden rules for investing. 1. Resist the overwhelming urge to sell your stocks when the market is down. Eventually, the market always goes up. 2. When the market crashes, it's a perfect opportunity to buy low. When stock prices rise, that's your chance to sell them. 3. Long-term investments carry the lowest risks and minimal fees. As a rule, you should hold your stocks for at least a year. And 4. Once you've made a transaction, let it go and continue with your life. Looking at your portfolio twice a year is enough, as investing isn't supposed to be stressful. The number one worst thing you can do as an investor is selling your stock during a downturn. Rachel Richards. There are 3 kinds of funds: domestic, only companies in the U.S., global, with stocks and bonds across the globe, including the country in which you reside, and international, all countries except your home country. Rachel Richards advises on investing for different age groups. Consider the following portfolio if you're a new investor between the ages of 35 and 45. 15% domestic small cap stock. Small capitalization stocks have higher potential returns. 20% domestic mid-cap stock. Mid-cap stocks can help you strike a balance between risk and reward. 35% domestic large-cap stock. This way, you will have a reliable stream of dividend income. 10% domestic bonds. This is a lower-risk investment with a fixed rate of return. 20% global or international stock blend. This investment offers a wider range of companies and markets. The ratio applicable to people aged 35 or under could consist of 25% domestic small capitalization stock, 25% domestic mid-cap stock, 25% domestic large-cap stock, and 25% global or international stock blend. If you're nearing retirement, the best strategy is to avoid high-risk investments. Thus, it would help to keep your funds away from small-cap companies. It would be best if you bought more bonds and large-cap stocks instead. On the other hand, you can start selling the stocks you have and move on to cash gradually. There are alternative ways to invest: real estate, cryptocurrency, commodities, hedge funds, and so on, yet they're more volatile and risky. Key point 6. Retirement can and should be fun. The older you get, the more your expenses grow, so you need a solid financial plan. However, many miss the point of retirement. You stop working not because you're old, incapable, or your time has come. You might want to reconsider your idea of retirement and start changing your approach to it now. What if we told you that you could retire young? There are 2 building blocks for early retirement: savings and passive income streams. It's never too early to start saving for your post-work years. Regarding savings, there are 2 popular options: a 401k account, a savings plan employers usually offer, and an IRA, also known as an individual retirement arrangement. You can set up this account yourself since it doesn't require employer sponsorship. Here's what you need to know about a 401k account. Many employers make matching or partial contributions, which is free money. Use it as much as possible. Other employer-sponsored plans, 403B and 457, are available for special categories of employees. If you leave your employer, you can still access your 401k retirement account. You can leave it as it is if you want to. However, it would be best to roll over your funds from a 401k account to an IRA, individual retirement arrangement. Think of your IRA account as a means to make your distant future clearer and more predictable. Earnings in most retirement accounts grow tax-deferred. The tax benefit depends on the type of your investment plan. Do your research to pick the one that fits your financial situation best. Nevertheless, there may be better ways to go than relying on savings alone. Depending on your income, it can take decades to accumulate sufficient funds. Moreover, you might be unable to afford your current lifestyle when you no longer work. Here's when passive income comes into play. You can put in some work up front and watch your revenue grow later. For instance, you can write a book or record a music album. Yes, creating and promoting your artwork will take some effort, but you will benefit in the long run. Alternatively, if you're not artistic, there are other ways to generate passive income. For instance, you can accumulate huge sums by investing in real estate. Key point 7. Control taxes and get insurance for financial security. Tax regulations are in a constant state of change and adjustment. You need to be aware of that because you are the one to ensure you only pay what is legally expected. Here's what you should know moving forward. Your gross income minus the specific adjustments you qualify for equals your adjusted gross income, AGI. Applying the appropriate tax rate lets you calculate your gross tax liability once you know your AGI. To arrive at your final tax liability, you need to subtract tax credits from it. Look at the sum you withheld the year before and compare the amounts. Try to determine whether you owe something to the government. However, you might be eligible for a refund if you have overpaid your taxes. If you want to adjust the amount your employer withholds from your salary, you'll need to fill out a new W-4 form. However, you are the only one responsible for withholding your taxes if you're self-employed. In the United States, the higher the income, the higher the taxes. If you're single and have no financial dependents under your care, life cover is not a must. Yet, if your loved ones depend on your income, a life policy might be their financial safety net. Term life insurance, for example, it provides financial protection only for a specific period, is better than whole life insurance because it is less expensive and usually more relevant. For instance, once your kids are grown up and are no longer financially dependent on you, you won't need life insurance. The amount of insurance you buy should reflect the standard of living you wish to assure your dependents. Rachel Richards. Another way to reduce the risk of financial setbacks is to buy long-term disability, LTD, insurance. Unfortunately, a debilitating illness or injury can make it difficult to scrape a living. Therefore, purchasing this policy makes the most sense in some cases. Still, while it's wise to consider insurance when you have dependents, it's not always essential. Only you know if you have enough money to sustain the people you love. Conclusion. Managing your finances is easy once you start paying enough attention to them. Different tools can help you simplify this task even more, not to mention all the automation tricks that will help you save money effortlessly for the things you want. Knowing where to start is always a good idea. Begin by making your money real. Conduct a monthly audit of your resources and know exactly how much you have left after completing all the necessary payments. Most importantly, Don't be too hard on yourself if you fail to become a financial wizard within a month. Learning how to handle money and make it work for you is a long and intricate process, but manageable. There are several keys to success, not just numbers on your calculator. To succeed, you need to write down your expenses, share your goal with other people, and have them help you reinforce it. Find the person to hold you accountable when necessary. And finally, praise yourself as you make some progress. You may feel deprived, yet choosing what matters most over what you want now always pays off. Sooner or later, your strength will turn into financial freedom. Try this. Start by writing down your every expense. You'll notice that you're spending much more money than you assumed. It will help you get motivated to save more and continue diving deeper into financial management. Then, find your golden number. Having done that, work on increasing it. And as you see it grow, start filling your emergency bucket.